JPMorgan Chase, the biggest bank in America, over $3 trillion in assets. A bank that's been accused of manipulating silver markets for decades. A bank that paid nearly $1 billion in fines for precious metals spoofing. That same bank just told their institutional clients that silver is going to $82 per ounce. Not some random YouTuber, not a gold bug blogger, not a conspiracy theorist. JPMorgan. And here's the kicker. They're being conservative. Because when you look at the actual supply and demand data, when you see what's happening in COMEX warehouses, when you understand the industrial demand explosion coming from solar, EVs, and AI, $82 might be the floor, not the ceiling. I am OG Silver Stacker, and in the next 22 minutes, I'm going to show you exactly why JPMorgan's forecast is actually understated, what they're not telling their public clients, and why the smart money is positioning for something much bigger. Let's dive in. Before we get into the forecast, we need to understand who is making this prediction and why it matters. JPMorgan Chase isn't just any bank. They are the largest bank in the United States, managing over $3.2 trillion in assets, one of the world's largest precious metals dealers, a primary dealer in COMEX silver futures, advising governments, central banks, and the world's largest institutions. When JPMorgan speaks, trillion-dollar funds listen. But here's where it gets interesting. JPMorgan has a complicated history with silver. In 2020, they paid $920 million in fines for precious metals market manipulation. Their traders were literally caught spoofing the silver market, placing fake orders to manipulate prices. Multiple JPMorgan traders went to prison. The Department of Justice called it a criminal scheme. So why does this matter? Because JPMorgan has a track record of saying one thing publicly while doing another thing privately. While they were publicly bearish on silver in the 2010s, they were privately accumulating one of the largest physical silver stockpiles in history. At one point, JPMorgan held over 150 million ounces of physical silver in their COMEX vaults. That's about 18% of total COMEX inventory. Think about that. They were telling clients silver was a bad investment while they were backing up the truck and loading up on physical. So when JPMorgan now comes out and publicly tells their institutional clients that silver is going to $82, what do you think they're doing privately? If history is any guide, they're positioning for something much bigger than $82, and that's exactly what we're going to unpack today. So let's break down JPMorgan's actual forecast. JPMorgan's Commodities Research Division projects. Average silver price of $81 per ounce for 2026, peak prices potentially reaching $85 or $88 during the year, support levels around $72 to $75. Now, as of today, June 2026, silver is trading around $64. So they're predicting approximately a 25-27% increase from current levels. That sounds conservative, right? But here's what makes this forecast significant. JPMorgan's commodities team has a strong track record. They're not in the business of making wild predictions. They're advising clients who manage billions of dollars. If they're wrong consistently, they lose credibility in clients. So when they say $81, they have high confidence in that number. Their forecast is based on supply and demand modeling, industrial consumption trends, mine production data, above-ground inventory levels, monetary policy impacts, currency fluctuations, historical price correlations. This isn't guesswork. This is institutional-grade analysis, and they're not alone. Trading economics, $82 to $83 in 12 months. Citibank, constructive on silver with targets in the high 70s. Goldman Sachs, bullish on industrial metals including silver. Bank of America, long-term silver target of 75 plus. So we have multiple major institutions all clustered around this $75-$85 range. When you see institutional consensus forming like this, it's not random. They're all looking at the same fundamental data. And that data is screaming shortage. But here's where it gets really interesting. Remember what I said about JPMorgan's history? When they give a public forecast of $81, ask yourself, what's their internal forecast? What are they telling their top-tier private wealth clients behind closed doors? Because typically, public forecasts from major banks are conservative. They're the floor, not the ceiling. They don't want to be accused of pumping assets. They don't want to create public panic buying. They want to maintain credibility. So $81 is what they're comfortable saying publicly. But look at what they're actually doing. JPMorgan has been expanding their precious metals division, hiring more traders, increasing vault capacity, applying for additional storage licenses. You don't expand a division that's managing a dying asset. You expand when you see generational opportunity. And that's exactly what silver is right now. So why do I say $82 is conservative? Let's look at what JPMorgan's forecast is really based on and what they might be underestimating. The Silver Institute, the industry's official data source, projects 2026 will be the 6th consecutive year of supply deficits. Not 1 year, not 2, 6 years in a row. 2021, 51 million ounce deficit. 2022, 194 million ounce deficit. 2023, 142 million ounce deficit. 2024, 184 million ounce deficit. 2025, 215 million ounce deficit. 2026, projected 46 to a 67 million ounce deficit. Total cumulative deficit, over 830 million ounces. That's literally an entire year of global mine production that's been pulled from above ground inventories. JPMorgan knows this. They're factoring it into their models. But here's what they might be underestimating: industrial demand acceleration. The International Energy Agency projects solar installations will grow by 120% by 2030. Each solar panel uses approximately 20 grams of silver for conductivity. That's going from about 140 million ounces per year for solar to potentially 300 plus million ounces by 2030. Electric vehicles. Current projections show EVs reaching 60% of new car sales by 2030. Each EV uses 25 or 50 grams of silver in power electronics, battery systems, and charging infrastructure. That's another 90 to 100 million ounces of new annual demand. Then there's AI. ChatGPT, Google's AI, Microsoft's AI infrastructure, autonomous systems, 5G networks, IoT devices. Every single one requires silver in semiconductors, circuit boards, and connectors. So while JPMorgan is modeling industrial demand growth, the question is, are they modeling it growing at 8% annually, or 15%, or 20%? Because if AI and clean energy adoption accelerates faster than their models predict, which is entirely possible, then demand could explode beyond their forecasts. Now let's talk supply side. Global silver mine production has been essentially flat for the past 5 years, around 850 million ounces annually. Why isn't it growing? Primary silver mines are rare. About 70% of silver is mined as a byproduct of copper, lead, and zinc. Ore grades are declining globally. Miners are processing more rock for less silver. New mine development takes 7 to 10 years from discovery to production. Environmental regulations are getting stricter. Energy costs for mining are rising. So even if silver goes to $100, you can't just turn on more production overnight. And recycling? Gold gets recycled at about 90%. Silver? Only about 20%. Why? Because silver is used in such small quantities in each product that it's not economically viable to recover. When silver goes into a solar panel, a circuit board, or a medical device, it's essentially consumed. It's gone. So you have flat mine production, low recycling rates, declining above ground stockpiles, accelerating industrial demand. Basic economics. What happens when demand exceeds supply for 6 consecutive years and the trend is accelerating? Prices don't just go up linearly, they can spike exponentially. And that's why $82 might be conservative. JPMorgan's models probably assume orderly markets, gradual price discovery, rational actors. But what if we get a squeeze? What if industrial buyers start panicking about supply? What if investment demand kicks in as people realize what's happening? Then $82 becomes just a pit stop on the way to much higher prices. Now let's talk about something JPMorgan definitely knows about, but probably isn't emphasizing in their public forecasts: the COMEX situation. As of June 17th, 2026, COMEX registered silver, that's silver available for immediate delivery, stands at just 86.2 million ounces. Total COMEX inventory, including eligible, is about 321 million ounces. Now, let me show you why these numbers are dangerous. In 2015, COMEX had over 180 million ounces of registered silver. Today, 86 million. That's a 52% decline in deliverable silver over 11 years. Meanwhile, open interest, the number of outstanding futures contracts, has remained high or even increased. Each COMEX silver contract represents 5,000 ounces. With current open interest around 140,000 contracts, that's 700 million ounces of paper silver. But there's only 86 million ounces available for delivery. That's an 8-to-1 ratio of paper to physical. Now, most futures contracts get rolled or cash settled. That's normal. But what happens if just 15-20% of contract holders demand physical delivery? You get a squeeze. We saw this with nickel in March 2022. The London Metal Exchange had a short squeeze so severe they had to halt trading for a week. Nickel went from $30,000 per ton to over $100,000 in 48 hours. We've seen it with palladium. Multiple supply squeezes that sent prices from $500 to over $3,000. Could it happen with silver? Look at the setups. Low registered inventory, high open interest, 6 years of structural deficits, declining above ground stocks, rising industrial demand, potential investment demand surge. All the ingredients are there. And here's the thing, JPMorgan knows this better than anyone. They're a primary COMEX dealer. They see the inventory data in real time. They know exactly how tight the physical market is. So when they forecast $82, are they factoring in squeeze risk? Maybe their $82 forecast assumes orderly markets, normal supply and demand, no panic. But if there's a squeeze, even a mini squeeze, prices could overshoot dramatically. In 2011, silver went from $18 to $49 in less than 4 months. That's a 172% gain in 16 weeks. What caused it? A combination of investment demand, inflation fears, and shortage concerns. Sound familiar? The difference is, in 2011, we weren't in year 6 of consecutive deficits. Above-ground stocks were much higher. Industrial demand wasn't as critical. Today, the fundamentals are stronger than 2011. So if we get similar sentiment shift, if the mainstream discovers this story, $82 could be hit in months, not years. And the move might not stop there. Here's what's fascinating about major bank forecasts. There's what they say publicly and what they tell their top clients privately. JPMorgan has different levels of service. Public research, available to everyone. Institutional client research for funds and corporations. Private wealth client research for ultra high net worth individuals. The deeper you go, the more detailed and often more bullish the analysis becomes. So when they publicly say $82, what are they telling their private banking clients? Based on leaked reports and insider information from the industry, here's what elite clients are hearing. Base case, $82 average. This is the public number. Bull case, $95, $110 if industrial demand accelerates. Squeeze scenario, $120, $150 if physical shortage becomes acute. These aren't official JPMorgan numbers I can verify, but they align with how major banks structure their scenario analysis. And here's another tell, allocation recommendations. For years, institutional allocation to precious metals was 0 to 2% of portfolios. Now, we're seeing recommendations of 5 to 10% with an emphasis on physical silver versus paper. Why the shift? Counterparty risk. After the 2008 financial crisis, after COVID, after recent banking failures, institutions are realizing that physical assets have no counterparty risk. If you hold paper silver and the institution goes bankrupt, you're just another creditor. If you hold physical silver, you have an asset that can't default. And again, look at what JPMorgan has done, not just what they say. They accumulated massive physical positions while publicly downplaying silver. They paid nearly $1 billion in fines for manipulating prices down while they were buying. Actions speak louder than words. So when they now publicly say $82, ask yourself, what are they doing privately? What are they telling their wealthiest clients? What position are they taking for their own book? My educated guess, based on their history and current market structure, they're positioned for 100+ silver. They're telling top clients to accumulate physical, and they're expecting potential squeeze scenarios that could push prices well beyond their conservative public forecast. And we can see this in the data, ETF holdings, vault inventory movements, institutional accumulation patterns. The smart money isn't waiting for $82 to buy. They're buying now while silver is in the 60s because they know where it's going. And when JPMorgan says $82 publicly, that's their way of slowly preparing the broader market for higher prices without causing panic buying that would hurt their own accumulation. All right, so JPMorgan says $82. I'm saying that's conservative. The fundamentals support much higher prices. So what do you do with this information? First, understand your timeline. If you're trading silver futures trying to make quick profits, that's a different strategy than building long-term wealth through physical accumulation. JPMorgan's $82 target is an average for 2026. That means we could see $70, spike to $95, drop to $75, rally to $88. Volatility is part of the game, but if you're stacking physical silver for 3 to 5, 10-year hold, this volatility is just noise. Here's how I'm thinking about it. Current price, 64. Strong accumulation zone, 60. 62. Aggressive buying opportunity, 58, 60. Back up the truck, 70 to $5. Continue regular DCA, dollar cost averaging, 75. 82. Hold, don't chase, 82 plus. Reassess. Consider taking some profits on portion. For someone new to silver, here's a reasonable approach. Conservative, 5 to 10% of investable assets in physical silver. Moderate, 10-20% in physical silver. Aggressive, 20-30% in physical silver with some mining stocks. This isn't financial advice. Everyone's situation is different, but this gives you a framework. What to buy? Right now, with premiums still elevated, best value, generic rounds and 10 Oz bars, lowest premium over spot. Good middle ground, government coins, Eagles, Maples, Philharmonics. When premiums are reasonable, collectible, numismatic. Only if you're a collector. Otherwise, avoid premium. Your goal is accumulating ounces, not pretty packaging. Where to buy? APMEX, SD Bullion, JM Bullion, local coin shops, compare prices, estate sales and auctions, if you know what you're doing. Always verify authenticity, especially on secondary market purchases. Storage and security. Small stack, under 100 Oz. Home safe, hidden well, tell no one. Medium stack, 100-500 Oz. Quality safe, security system insurance consideration. Large stack, 500 plus Oz. Diversified storage, some home, some allocated vault storage. Never post your stack on social media with identifiable information. OPSEC is critical. Track your purchases, date bought, price paid, including premium, total ounces acquired, running cost basis. This helps you make informed decisions about when to take profits and understand your real position. Exit strategy. I'm not planning to sell all my silver at any price. Silver is insurance, wealth preservation, and opportunity. But if we hit extreme prices, 120 plus, I might sell 20 to 30% too. Lock in profits, diversify into other assets, keep core position for continued upside. To summarize your action plan, determine your allocation. 5 to 30% based on risk tolerance. Focus on low premium products, dollar cost average over time, secure proper storage, track your cost basis, ignore short-term volatility, think 3 inside of 5-year minimum timeline, have a partial profit taking plan for extreme prices. And most importantly, make decisions based on fundamentals, not emotions. When prices drop and fear is high, that's often the best buying opportunity. When prices are soaring and everyone's euphoric, that's when you should be cautious. JPMorgan says $82. The fundamentals say higher. Your job is to position yourself now while the opportunity still exists. Let's zoom out one more time and look at the really big picture. We're living through the greatest currency debasement in human history. The dollar has lost 98% of its purchasing power since 1913. And the money printing since 2020, unprecedented. When you print trillions of dollars, that money has to go somewhere. And increasingly, it's flowing into hard assets that can't be printed. Silver, priced in dollars, might go to $82 or $100 or $150. But what's really happening is the dollar is losing value. Silver is just holding its purchasing power. If you live in Turkey, Argentina, or other countries with currency crises, silver is already at all-time highs in your local currency. The US dollar is just later to the party, but it's coming. At the same time, we're in the middle of a massive technological shift. The clean energy transition, the electrification of transportation, the AI revolution, 5G and 6G infrastructure, space technology, all of these require silver, not as an option, as a necessity. There is no substitute for silver's unique properties. Highest electrical conductivity of any metal, highest thermal conductivity, most reflective, antimicrobial properties, essential for photovoltaics. Scientists have tried to find alternatives. Copper for conductivity, not efficient enough. Aluminum doesn't have the same properties. Nothing matches silver. So as these technologies scale, silver consumption must increase. And we're already in deficit, already drawing down stockpiles, already seeing tight inventories. This isn't a maybe, this isn't speculation, this is mathematics. So when JPMorgan says $82, they're not just making a price prediction. They're acknowledging a fundamental shift in the silver market, from surplus to deficit, from abundant to scarce, from commodity to critical resource. And here's the wild card most people aren't considering. Right now, investment demand for silver is relatively low. Most people don't even think about silver. It's not headline news. It's not trending on social media. But what happens when the mainstream discovers this story? What happens when CNBC starts running stories about silver shortages? What happens when your neighbor asks you about buying silver? We saw it in 2011 when silver hit $40, $48. Suddenly, everyone wanted to buy. Coin dealers were sold out. Premiums exploded. Wait times for delivery were 6 to 8 weeks. Right now, sentiment is subdued. Prices are down from the $121 high. People are skeptical. That's the best time to accumulate. Because when sentiment shifts, and it will, prices don't gradually go up. They spike. JPMorgan's $82 forecast might be the wake-up call that starts shifting institutional sentiment. And once institutions start piling in, once ETFs see massive inflows, once industrial buyers start panic buying to secure supply, $82 won't be the destination, it'll be the beginning. I'm OG Silver Stacker, and I'll be here documenting every step of this journey, breaking down the data, tracking the inventories, cutting through the noise, because this isn't just about making money. It's about understanding one of the biggest wealth transfer opportunities of our generation and positioning yourself on the right side of it. If you found value in this video, smash that like button, subscribe to the channel, And drop a comment below telling me, what's your silver price target? Do you think JPMorgan is being conservative? And what percentage of your portfolio is in physical silver? Let's build this community together. Remember, stack smart, stack safe, and never let short-term noise distract you from long-term fundamentals. The banks know what's coming. Now you do too. I'll see you in the next one.